Good afternoon, good evening, and good morning, depending on where you are. My name is Sean Overton, and you are attending the live Google Hangout. Crush it with the Slow Stochastics. This is a free indicator provided by my website, q.onestepremoved.com. The goal for this webinar is to keep it around 20 minutes. I want to get straight to the point to show you how to analyze the stochastics so that you can put this to work immediately in the market. We're going to go through a couple of key points. The key question is what we're trying to predict and why it's important. We'll cover stochastics very briefly so we can bring you up to speed on how the indicator works. And then we're going to use the free Quantitator tool so that you can see exactly how it works, how it operates, and how you can get the most impact directly from the stochastics indicator. And we learned last week what you want every indicator to tell you is basically two things. You want to ask the question, hey indicator, is the market going to go up or down at some point in the future? And then you want to know in the future, how much is it going to go up or down? Now, if you think about these two questions, they're really one question, right? If the market's going up positive 20 pips, well, that already tells you that the market's going up. Or if the market's going down 35 ticks, then you know that obviously the market is negative 35 ticks, then obviously the market is declining. Really, this is just one question. Think of this visually. This giant arrow would be a world-class indicator. Whenever the indicator gives you a certain number, you would want it to ideally tell you that there is a large move expected at some point in the future. And if you have a mediocre indicator, as indicated by the meh, that might give you a small predicted value in the future. So the larger, assuming the indicator is accurate, the larger the predicted return, the more useful it is. And you don't really care about the direction, but you do care about the sign of the anticipated direction. So if it's a big positive number or a very small negative number, that is really useful. If it's a small negative number or a small positive number, it's not so useful for you because you're going to have trading costs, slippage commissions, and so on. Now, one thing to keep in mind, we are talking statistically. You're not going to be able to just use the indicator and 100% of the time get the answer you're looking for. There is a strong average predicted value that you'll be able to use with stochastics and with this quantitator process applied to any indicator, but it's an average. It's not going to happen every single time. There will be winners, there will be losers. And when we're looking at stochastics today, we're trying to analyze what is the future return, the average future return at some point. So if you think about this as a real hard and fast question, say that the Slow Stochastics is currently reading 40, and it's a 1 hour chart, and you want to know what is likely to happen on average in the next hour. What you're really asking is, okay, when the stochastics is, what is the average return in the next hour, positive or negative? And that's what we're going to answer today. So I want to take a look at the stochastics indicator in MetaTrader real quickly, just to bring you back up to speed about what it is and how it works. So I am going to switch my screen here. Okay, and here on the chart, you can see I have the stochastics indicator applied. And let me see if I can thicken these lines because I'm worried about those of you watching on this as a Google Hangout that it might not be so clear. So let's make these super fat. That was the wrong one. Okay, so that should be clear to everybody watching. With the stochastic indicator, there's really 3 values that you can get out of this. So this blue line is the K, it's called %K, And then this red line is percent B. So percent K is actually a single smoothed reading of the high and low values over a moving window. And then the red line is a smooth version of this blue line, which is smoothed. So you can think of this blue line as a single smooth window and this red line as a double smooth window. Lastly, you can create a histogram based out of this. And this is something I unfortunately didn't have time to complete before this training, but the histogram would be simply this blue line minus the red line. So if the histogram is positive, it means that blue is above red. And if the histogram is negative, it means that blue is less than red. As you can see, it's an oscillator. It ranges between 0 and 100. And the theory is that when the price goes above 80, that the market is oversold and should revert to the mean, i.e. 50. So you would expect the market to decline when the stochastic is high, and you expect the market to rise when the stochastic is low. And this is just an anecdote. You shouldn't completely draw conclusions based on this, but you can see that these peaks in the stochastic indicator is roughly mirroring what's happening in the market. It's not timing the peaks exactly, but it's pretty close. And for this type of market condition, it's really appropriate. So with that, and I just realized that it may not have been showing to everybody. Were you guys seeing the screen as I presented that? Well, just in case, let me go through this real quick again. So the blue line is the percent K. This is the single smooth line. And the red line is the double smooth line, and that's referred to as the percent D. And if you want to create a histogram, it would be the blue line minus the red line. And you can see that stochastics here in the current market conditions is roughly mirroring highs and lows on this chart. Okay, so with that, let me switch and go back to the slides. I'll be this up in just a second. Okay, so here on the screen, we have the quantilator loaded. And I'm going to put the window, if you're watching on as a webinar registrant, then you'll be able to see this box in the top right corner that says, click on the image, use the quantilator for free. You can go ahead and do that at any time if you want to follow along with me. Otherwise, just go ahead and watch the screen. And if you're watching on YouTube, you won't be able to see these or to type in the chat box, but you'll at least be able to see what I'm doing. So here on the screen, I have the stochastics indicator page loaded, and it's asking me several options. For now, bins is just going to tell me how segmented do I want to make the stochastics. We're going to leave that alone. And for the testing plan, I'm going to stick with using the defaults that everybody uses in the market. And we're going to analyze how predictive just the percent K line is on its own. And if you recall, percent K was this blue line here in MetaTrader. And when I do that, when we're analyzing one bar in the future on 1 hour data. So this is telling us when the percent K is a certain value, how much do we expect the market to go up or down? And this is already a fantastic start. It's not very often where you see indicators spit out such a clear sign of market direction. And if you look here, you can see that the Slow Stochastics indicator is negative 95% correlated with average future returns. So, and I see a lot of people get confused about what a negative 95% correlation means. A lot of people immediately jump into the assumption that this means that it predicts 95% of trades correctly. Not true. What that means is that with a very high degree of relevance, as the stochastics indicator increases, the average return decreases. It doesn't tell you anything about how much, and it doesn't tell you anything about percent accuracy. It just tells you that there's clearly a relationship between the stochastics indicator rising and the average market direction decreasing. So if you look at this here, what this is saying is that when the stochastics on the 1 hour chart of the euro US dollar, 33 is the settings, reads 28. When the slow stochastics on with these settings reads 28, the average return, 1 bar in the future, is about 0.05%. And then as you get more towards the extreme, so when the slow stochastics reads 69, you basically get the same return but in the opposite direction. So low stochastic values predict upward market movements, and high stochastic values predict downward market movements. But that doesn't mean that we're stuck there. We can do better. And what we're going to do is we're going to walk through different ideas for how we might get these predictions to be even more useful. If you think about the euro US dollar, which trades almost, the euro trades almost at parity with the dollar. These are in percentages, but this is almost exactly the same as pips. So these predictions on their own are coming reasonably close to covering spread costs if you're trading in an ECN broker. That's not going to cover a marked up spread, or it's not going to cover commissions, but even this on its own is enough to bring your trading away from worse than random because of the trading costs, at least relatively close to random, just on this sole basis without making any improvements, which is fantastic, because when you add indicators that have edges like this and you use 2 or 3 of them or even 5 of them, and you're able to get them to play nicely together, that's the basis of a trading strategy. But let's take a look and see how these default settings might change as we go further into the future. So we've clearly demonstrated that this appears to predict 1 bar in the future. Let's see if we can get these bars to go up, if we can get even stronger predictions. And what you find is that it's actually gone down slightly. So it looks like the effect on these more extreme values might actually be decaying as we go further into the future. So we'll try 3 bars. This is currently on the screen 2 bars in the future. And now I'm going to show you what 3 bars in the future looks like. Okay, so it's basically the same as where we started, kind of plus or minus. At least the relationship is still really clear. But as we get even further into the future, so let's try 5. By this point, it's starting to get muddled, right? There's no clear relationship. And by the time we get to something a little silly like 10, which is way outside our window, even though you have still the same type of relationship, the magnitude has decreased by basically 3 or 4-fold. So it makes a lot more sense to stick with the shorter period where we have the less time risk in the market and where the predictive impact seems to be the strongest, and where logically you would expect it to have the strongest impact. Now, there's nothing magical about the settings 533. And a lot of the reason I created this tool is so that I could quickly walk through different hypotheses about the way this indicator might work and how it might benefit me. So what I'm doing is I'm going to try changing K to bigger values, because we're studying a 1-hour chart and it doesn't make sense. There's nothing special about a 5-hour period. That doesn't even really make sense. It makes a lot more sense to look at something that's meaningful throughout the day. So the length of time for the Euro, the US, or the Asian session is roughly about 8 hours. So I'm going to start by testing 8 and seeing what impact that has. And you can see that the magnitude of the more extreme stochastic values has increased. And I'm just going to keep increasing this and see how far I can get until I reach some sort of peak. So I'll try 12 because that's half a day. And you can see that the impact is getting even stronger. So I'll try 16. And that seems to be quite strong, although it's a little worrisome that this is starting to fade, where the peak impact has moved from this far right bar to this far left bar. And then by the time I get to a full 1 day period, 24 period K, you can see that basically the impact is gone. This magnitude's dropped from being about 0.08% down to 0.3%. So we basically killed it. And I found that the peak impact is occurring basically around 12, where I have a 0.08% rise when I have low stochastic values, and I have about a 0.05% decline when I have high stochastic values. Now, one of the key features that's different from last week with the CCI is that you can apply different filters to test hypotheses about how the indicator might interact with itself. So you notice that I started by analyzing the K line, this blue line, but I also considered the idea of whether this red line had value. And instead of taking you through that, I'll just give you the heads up shortcut. My answer is no, I don't find the %D line to add any value whatsoever to my analysis. The other idea I found interesting was to think about the histogram, which again is not displayed in MetaTrader, but it's just the blue line minus the red line. So if you get a positive number, that would imply that the histogram is above 0. And if you get a negative number, i.e. blue is less than red, then the histogram is less than 0. Now, my expectation was that this might actually be quite useful. And so what I tried to do was to leave the settings here on exactly as is, but change my filter from %K to the histogram. And when I analyze that, seems like we're off to a decent start, but it's not as good. So what I thought is maybe if you think about the way stochastics works, this K line is actually already single smoothed, and then the D line is double smoothed. So it might make sense to decrease the period because 12 is meaningful, but a lot of that is embedding older data. So I tried shortening the data, and I found that 8 is starting to make didn't really have too much impact. And then as I drop it down to 7 and trying other values, you notice that you get completely wacky behavior. We made a very small change. Here's 8, right, where this is supposed to be positive when the difference between K and D is negative, and this is supposed to basically be negative when the difference is positive. And you make a 1 period change, and you get completely different outcome. So this is graph 2, and then this is graph 1, right? It's night and day. And when you see that kind of indicator sensitivity and changing one small setting gives you a completely different outcome, to me, that's a gigantic warning sign that this is something to avoid. So for me, what I found was that the %K is far and away the best value by far. And a better way to highlight this, so using 1233 as the settings, using %K strictly as the tool for your analysis, and then I wanted to see how much impact does it have when you get more and more extreme values. So instead of just plotting 4 bars like I've been doing, I changed it so it's plotting 8. And what you can see is a pretty visually obvious relationship that this is going from top to bottom. And you get a value that's almost predictive of an entire pip when the stochastics is reading in the 30s, especially the low 30s. And again, you get about 3/4 of a pip when the stochastic is reading about in the mid 60s. And so what that tells you is that as stochastics gets more extreme, it follows exactly the theory that it purports to follow. that the predictive value is getting better and better as the stochastics gets more and more extreme. And if you want to run this tool yourself and you're in the webinar, you can just right-click on the box at the top right corner that has the orange button, Analyze the Indicator. And that'll take you to this page. And before you're able to fill out these settings, just enter your email address, push Analyze, and it'll take you right to the form and show you these types of graphs. And let me put it back in presentation mode. And before we go, I'd like to thank my sponsor, Top Trader. They are the ones that have helped me put this together. Top Trader is a free service that allows traders to go pro before they have to do any work at home by themselves. So normally, if you want to raise money and become a professional trader, you have to go find your own customers, you have to go get your own licenses, you have to usually trade for years before you're able to earn your own allocation. And what Top Trader does is it believes in crowdsourcing to find the next talent. So what you do is you sign up for Top Trader, and when you link your live account, you'll be able to automatically feed your trades over to Top Trader. They're analyzing your trades. It's 100% automated, so you don't have to worry about the politics or keeping any kind of boss happy. If you are earning smooth, steady returns at a reasonable degree of risk, then chances are you're going to get an allocation in a very short period of time. The largest trader on there is Amir Salman, who is an Egyptian, and he started at home just trading a regular account like everybody else. And by establishing a solid track record, he currently has $120,000 under management. So that's a really easy opportunity. If you're in the webinar, you can just click on the orange button and it'll take you, or on Amir's picture, and it'll take you right over to Top Trader so that you can sign up. Or you can type in the link that you see here on the screen, bit.ly/2, M like Mike, N like November, L like Lima, 6, C like Charlie, O like Oscar. And with that, I'd like to open it up to any questions that you might have. And you can just go ahead and type in the chat box, and those will go straight to me. All right, Bob asks if you can use the stochastics solely as the basis of a trading strategy. No, you need to pair it up with another indicator in order to get the full value out of it. The stochastics is a standalone indicator, and it's extremely unlikely that you're going to be making buy and sell decisions based on a single indicator. A realistic expectation for a strategy is to pair up several edges like this. So you notice that when we did some analysis, our best predictions were just getting to the point where they were likely to overcome the spread costs, but they weren't enough to go in and place trades entirely based on one indicator. The expectation for an indicator should be exactly that, to have an idea of the average expected return on its own. It's when you pair multiple indicators together, along with the entry and exit strategy and along with your position sizing, that it turns into a full-fledged trading system. For now, the goal is to build the toolbox. Joe asks if the webinar replay will be available. Yes, it is, and I'll type it into the chat. It's available also on my YouTube channel. And it'll be there pretty much within, I'd say, 10 or 20 minutes of this being over, so you'll be able to watch the replay almost immediately. And I'll type this for you, Joe. But I want to keep it short and sweet, so if you got any questions, make sure to type them immediately. Otherwise, I'm going to try to wrap it up in the next minute or so because we're already over 20 minutes. All right, guys, I appreciate your time. If you do have any questions after watching this, you can reach me at info@onestepremove.com. And let me pull the link back up so that you can view the link to go play with the indicator. It's q.onestepremove.com, indicator/slow-stochastics. My name is Sean Overton, and thank you so much for joining me today. I'll see you at the next training.